Ladies and gentlemen, welcome to the March quarter 2010 webcast for Cadence Capital Limited. I'd like to start with a chart of the point of maximum optimism at 6,800, falling to the point of maximum pessimism at 3,100, and recovering to a point halfway between those two extremes, 5,000, which is where the All Ordinaries Accumulation Index is right now. This has all occurred in a very short space of only 3 years. During that period, the period of March 2010, Cadence Capital Limited has produced a return of around 5.5% against a market that produced 1.5%. And over the longer term, we've produced 50% for the year and around 10% outperformance since inception. The pleasing thing about the quarter we've just been through is that the market fell 9% before recovering to be up 1.5%, whilst our fund fell very slightly during the first 6 weeks of the quarter and recovered to be up 5.5% for the quarter. We declared a fully franked dividend of 2 cents in August 2009 and again a 2 cent fully franked dividend in March of 2010. The exposure slide you see on the following page illustrates an exposure that has gone from 120% net exposure to 20 or 30% net exposure, back up to 120%, and now sitting at around 100% net exposure, i.e. we are fully invested but no greater. We have exited a small short position that we had, TCL, during the quarter, and so that our net exposure is 100%. Turning now to the sector exposure for the fund. The fund has heavy weightings towards banks, materials, software and services, and diversified financials. The three sectors where Cadence Capital has outperformed during the quarter include banks, telecommunications, and materials. The fund underperformed in software services during the quarter. Breaking that performance down by stock, the stocks that significant positive performance for the fund were RHG, TPM, FirstFolios, Nikkei Platinum, Reckon, Customers, Atlas Group, MacArthur Coal, MECO, and AVO. The stocks that underperformed for Cadence Capital Limited included Comops, PIH, Pan Australia, and Bravura. Now delving into one of the stocks in our portfolio that we've significantly added to this quarter, I'd like to spend a little bit of time talking about FirstFolio's ASX code FFF. On the 27th of August 2009, FFF announced that they would produce a $10 to $11 million EBITDA for the year ended June 2010. This was a significant upgrade compared to their previous year's performance. We've looked at this company on and off for about 6 years, and whilst the company has been run very well operationally historically, they have tended to oscillate between profits and losses over that period, due mainly to business cycles and company-specific issues. FFF is essentially a mortgage administrator and distributor, and prior to this announcement had been undergoing a transformation that we were unaware of until this announcement came onto the ASX. We followed up on the announcement on the ASX by downloading previous year's annual reports, the half-yearly report, and organising a company visit with the company. And what we learned from our analysis was that a strategic acquisition had been made into a company called eChoice, which was purchased from private equity. The eChoice business had previously had large amounts of capital invested into it and had developed a very robust IT platform which allowed FFF to significantly scale their business. The nature of FFF's business previously was that it had high fixed costs, which were then met by revenues that tended to oscillate ever so slightly, leading to extreme expansions and contractions in profit. Now with the eChoice acquisition, any relatively small revenue increase leads to a significant increase in EBITDA, which has essentially transformed the nature of the business. We acquired our first stake in FFF at 4.5 cents, not long after the announcement to the ASX indicating the $10 to $11 million EBITDA. And then we again acquired additional stock when the company did a rights issue and placement at 5.5 cents per share. The additional funds that FFF has raised is allowing the company to acquire other people's mortgage books very cheaply and to integrate them into the eChoice platform, thus allowing them to make incremental revenue gains, and this leads to significant profit growth for the business. As a result, FFF is displaying strong earnings growth characteristics at a relatively good valuation. It tends to illustrate how, for us, we've pyramided into a position that initially has shown good earnings, but now we're adding to that position because the earnings growth is actually increasing. By way of summary and outlook, I'd like to follow on from our AGM commentary in November 2009 and indicate that the market had fallen significantly, but was in a state of recovery and continues to be in a state of recovery. The stock market is climbing a wall of worry. People are worried about the strong recovery we've seen from 3,100 to 5,000, but that recovery looks in place. Following the worst stock market crash in 75 years, we have become highly attuned to processing negative information, but there are signs of positive earnings growth out there in particular stocks and in particular sectors of the economy. At this stage in the recovery, we are looking to companies and doing a lot of company visits trying to ascertain which of those stocks and which sectors are displaying strong earnings growth and at reasonable valuations. This has allowed us to be reasonably optimistic in the sense that we are finding a number of opportunities, and that we believe in the remainder of this financial year and the calendar year, a number of further opportunities will present. Thank you very much for your time listening to this webcast for March 2010. And if you do have any suggestions for us to improve the quarterly webcast, please send us an email at info@cadencecapital.com.au or call us at the office, and we'd be quite happy to implement changes. Thank you very much.